Oil prices are hovering near a two-month high as tensions escalate in the Middle East and concerns mount over the early start of the Atlantic hurricane season. Brent crude is trading close to $87 a barrel following a 1.9% increase on Monday, while West Texas Intermediate is above $83. Simultaneously, Hurricane Beryl made landfall as a Category 4 storm, raising concerns about the severity of this year's hurricane season. These factors, along with OPEC Plus's supply cuts and increased travel during the summer, are contributing to the upward momentum in oil prices. However, worries about China's economic recovery and its impact on crude demand may limit further price gains. So this morning, Esther Otusanya, a senior investment analyst at Meristem Securities, joins me to talk more about this. Thank you so much, Esther, for joining us.
Thank you for having me. Good morning.
So it appears a double whammy for the global oil markets these last few months with the Israel-Hamas-Hezbollah crisis and the bellowing hurricane. Now, if these continue, then we may not have seen the last of a spike in prices and probably further disruptions in terms of supply. So what are your thoughts and what do you think the implications are?
The geopolitical tensions in the Middle East added further upward momentum to oil prices as we saw it's almost 2 months high. Has been maintained previously at $70 to $80 per barrel, $78 per barrel since the war started. But with recent supply-demand challenges as well, looking at the hurricane, which could pose a lower expectations in downstream demand and eventually feed into lower demand from refineries. So these are all what we expect in the near term might serve as a maybe shock to the oil market, and we might see like further upward prices.
So with the increase in price and the discussions around moving away from carbon emissions, are demand still high in the global markets?
Well, yes, we're looking at it like on maybe half-on-half basis, like the first half in comparison to what we'll be expecting for the H2 2024. But on a year-on-year basis, the expectation is that demand for oil, goods of demand will actually reduce. I mean, even the OPEC and the International Energy Agency has also corroborated this because they highlighted the expectations of weaker demand. And although China is seeing like stronger activity, and this might be the biggest importer of oil and consumer of oil, this might actually help the this lower demand prospect, and you might see maybe a resurgence in the demand prospect for H2. But looking at the trajectory right now, it is still quite uncertain how demand for oil will play out in the second half of the year.
So let's now escalate down to Africa. Nigeria has been struggling with meeting production quotas. Angola, on the other hand, seems to have a blooming oil-producing sector. But then how much of a potential revenue boost could this oil price increase bring to Nigeria and Angola, considering their dependence on oil exports?
Well, surely both countries they are quite dependent on oil export, like you mentioned, and oil revenue serve as the main buffer to their booster to their GDP. And but for Nigeria, we see that oil generally, really, oil price isn't something that is in control, is within the control of the country or the government of the particular country. So more focus should really be on production outputs rather than oil prices. And I think for the budget forecast for these countries, and they must have forecasted like for Nigeria and Angola, they must have forecasted a particular range for crude oil prices. And the best thing to do really is to expect lower crude oil prices rather than budgeting for higher crude oil prices. I think for Nigeria, it was around $7.96 per barrel was budgeted for 2024. So I think oil prices have really been around this level. So since it is not looking to fall anytime soon, we expect maybe a further increase. It's actually something positive for them, for both countries, for Nigeria and Angola, saying that it means that the shortfall in, for Nigeria, the shortfall in the oil production output would be will be supported by the increase in oil price.
So we know that for Nigeria, like I said earlier, a bit of struggles in terms of the unrest or the volatility, or let's even say theft around the oil-producing areas. But then when we look at it from the other side, we see that there's a possibility that this Israel-Hezbollah conflicts and, of course, hurricane might just have an effect on Nigeria's crude markets. But then when you look at it from your own end, do you think that could indirectly disrupt oil exports for both countries, that is Nigeria and Angola now?
So the major determinants will be the trade partners of both countries, and I know for Angola there has been a lot of outings by the there's been a lot of outings to actually increase their trade partners, and they've actually made new agreements with some countries, some other countries for the export of their crude. But for Nigeria, we see the major crude partner of Nigeria is actually Europe. So the potential slowdown in downstream demand due to the hurricane might mean like lower demand from European refineries. And if there's lower demand from European refineries, it means that it is bound to impact exports from Nigeria specifically. And earlier this year, we even remember that Nigeria had a lot of oil in stock that was just sitting and without seeing any buyers. So if we should see that the possibility of slowdown or escalation of the conflict that might mean lower demand and also the hurricane, it means that there might be some issues around exports for Nigeria. But I think the government is already doing a lot to actually increase and to actually improve and also meet new trade partners, and this shouldn't be able to cause significant impact on the country's revenue for the next term.
Okay, so we are hoping that also for these top producing countries, not only for Nigeria anyway. Esther Otusanya, Senior Investment Analyst, Meristem Securities, thank you so much for your time.
Thank you so much for having me.